Today we're going to cover Chapter 29, which is titled The True Secret Behind the Indexing Concept, the Annual Reset. You learned the basics of the indexing concept in the previous chapter, and that was the indexing concept was designed to allow you to make money when the market goes up, but not lose any money when the market goes down, not lose any of your current or previous gains when the market went down, basically protecting you from investment risk. Well, what we'd like to do is teach you that the indexing concept strategy, it's best accomplished through what is called the annual reset. It's the secret behind the indexing concept. And it's so powerful that you have to understand the four major premises behind this. The first is the worst annual return credited to the account is 0%. So that's huge. The worst annual return you can get is 0%. The second is the account value will either go up or in the worst case stay flat every year. So isn't that pretty cool? The worst case, it will go up or stay flat. It can never go down. The third is that all current and previous annual gains credited to the account are locked in and can't be lost because of current year losses or future year losses. So think about that. All current and previous annual gains are locked in. Current losses cannot decrease that, nor can previous or future losses. I can't say that. Are you going to be able to splice that in, or you got to start it again?
Because you couldn't say that last part for the insurance?
Maybe. What part? I don't know.
That last part. You said, oh, I can't say that. Yeah, we can cut that out.
No, I'll just say. The third is that all current and previous annual gains credited to the account are locked in and can't be lost because of current year losses or future year market losses. So that's saying whatever you make and whatever you made before can't be lost because of current year losses or future losses. And the fourth is what it means. It works as if all your previous gains are protected, and for future gains you start all over again at the beginning of each year. This simply means that what you made previously can't be lost, and there's an opportunity for additional gains in the future. And isn't that what every single person wants? We're going to protect what you made, and we're going to give you the opportunity to make more money in the future. And that really comes down to what the annual reset is all about. We're going to look at, in this chapter, specifically what's called an annual point-to-point method with an annual reset. That means everything that you've made previously can't be lost, and each year you get to start over for potential gains. Remember, worst case every year is a 0% rate of return, even if the market falls by 40% or 50%. If you look at what happened in the S&P 500 index from 1999 through 2013, there was some severe lost time period, some severe volatility. In 2000, 2001, 2002, the S&P 500 index decreased by almost 50%. In 2008, the S&P 500 index decreased by almost 40%. Your assets would have been subjected to losses. In fact, in most cases, we've seen so many retirees lose more than what the S&P 500 index went down by if they were invested in the stock market, either directly invested in stocks or mutual funds or managed accounts. The goal is to avoid those losses. So as you look through this chapter, read it, review, you'll go and you'll understand our flatline approach again. When the market went down severely, you flatline, meaning your worst case return was a 0% rate of return using indexing concept. Then as you move further and further into this chapter, you'll start to understand the annual reset. And you'll notice that in 1999 that the market went up. So the market went up by 19.53%. And let's assume you had a maximum 6% gain that year. You went up by 6%. So the market went up 19, you went up 6. You might not feel that good. But then in the next 3 years, the market went down consecutively, a loss of 10%, and then another loss of 10% plus, then another loss of 10% plus. So in that case, we've lost 50% almost over 3 years. Well, your account stayed flat. You earned 6% in the first year, you earned 0% in the second year, 0% in the third year, 0% in the fourth year, meaning you haven't lost like the S&P 500 index decreased by. And you can look at this on an annual basis that when the market goes up, you earn a percent of the market up to that 6%. When the market goes down, you never lose anything, and your previous gains are never affected by current or future losses. We think it's an awesome technique. That annual reset inside of an index concept provides you that opportunity to get a rate of return over the long haul without subjecting your principal to risk. So again, the goal is to make money when the market goes up and not lose any money when the market goes down. Protect your assets against investment risk.